Welcome to the Real Life Planning Podcast. I'm Cynthia Meyer. I'm a real estate investor and financial planner. And today I'm going to talk about buying a property with subject to financing. Is this a smart strategy? Is it a risky endeavor? We're going to break it down. I've seen a lot in my practice during this high interest rate environment. I've seen more creative financing for investors to try and get into deals where they might have a more advantageous interest rate environment. And this is why subject to financing has really gained in popularity. Now, I want to start off by saying a couple of things. One, if you're listening to this, I want you to take this as education first. This isn't a recommendation for you to go out and do subject to financing deals. This is really only for experienced investors who have a strong cash flow position and can afford to take the risk. But it is something that we do see in our practice. Occasionally have clients who have acquired properties subject to. So I think it's an important strategy to know about it, but it's not necessarily something that you are going to go out and do yourself unless you're a really experienced real estate investor who really understands his or her local market and has a strong cash position. This is not a strategy for passive buyers, for people who have low cash reserves. The second thing is that this is something you do with a real estate attorney. You are not going to DIY it. You do need legal advice. I'm not an attorney. I'm not going to give you legal advice. Just think about this as education. So now that we've put the disclaimers out of the way, what is a subject to purchase? So a subject to purchase means that the buyer takes ownership of the property, but the existing mortgage stays in the seller's name. So the buyer makes payments on behalf of the seller to the seller's existing mortgage, but the loan is not assumed. This is not a loan assumption, and it's not refinanced, at least not in the beginning. So the deed transfers to the buyer, but the loan does not. So that's what a subject to deal is. The buyer takes ownership of the property. The mortgage remains in the seller's name. The buyer continues to pay the seller's mortgage, but the ownership of the property transfers to the buyer. Now, in real life, practically, who would do this, right? Who would sell their property and not pay off their mortgage? Generally, you're looking at sellers who are in some kind of financial distress. Possibly they have a property that they need, maybe they're about to go underwater, a potential foreclosure or short sale. It could be that they need to get out of the property for some reason, like a death or a divorce, and they don't have the cash flow available to fix up the property in order to put it on the market and get a decent enough price to pay off their mortgage. Usually there's some kind of distress or possible distress sale involved in a subject to deal. Those real estate investors that specialize in this area are generally looking for property sellers who may be in a cash flow crunch. So I think a key distinction here is the subject to does not equal a loan assumption, and it doesn't equal seller financing, right? So the existing loan is staying in the name of the seller of the property. The title transfers to the buyer. Okay, let's do a simple example. Let's say that there is a seller who has recently lost their partner and needs to get out of the home. They cannot continue to make payments on the home. It's too much for them. The home may need a little maintenance and renovation in order to be able to put it on the market and sell it at a decent price. They do have a nice 3% mortgage on that property, and that's attractive to the buyer. The buyer wants the property, maybe has cash flow to make the needed repairs or renovations, but either doesn't qualify, maybe because they have a whole bunch of loans on other places, or they just don't want to refinance that mortgage debt at today's higher interest rates. So the buyer purchases the property subject to the existing loan and continues payments. So how does that work on a step-by-step basis? So the first thing is that the seller and the buyer agree on the price and terms. They need to have a written contract. This is where the lawyers get involved. The buyer discloses in writing that the loan will remain in the seller's name. The property deed then transfers to the buyer. Now, this is typically done by a warranty deed, and that warranty deed is going to note that there is an existing mortgage on the home or property. So the buyer takes control of all the payments, the insurance, and the property management. The buyer is going to make payments to the seller's mortgage company directly. They need to be named as an insured on the insurance, for example, and the loan just continues to be paid off as before. Again, common scenarios where this is used is a seller facing foreclosure, a divorce or estate situations, low interest rate mortgages that are worth preserving. The buyer is really trying to tempt the seller into leaving the mortgage on the property, for example, or sellers with little or no equity. So consequently, they don't have as much incentive to get to a normal close where that mortgage is paid off. So let's just talk a little bit about why an investor would be interested in a subject to deal. Now, some of the advantages for the real estate investor, and again, only an experienced real estate investor, some of the advantages are access to below market interest rates. They don't have to go out and qualify for a new loan. So let's say that maybe the investor already has the maximum number of conforming loans, for example, and would have to go to a DSCR loan or something like that if they were to buy the property. So the rates would be even higher. Certainly, there are lower closing costs. There's some legal costs to the transaction, but it's certainly cheaper than closing a traditional loan. It's faster. If the buyer is a cash buyer and get this done in a couple of weeks, and it can improve the property cash flow dramatically. As financial planners for real estate investors, we see that the folks that are doing this are really doing it to improve cash flow and as a risk management strategy so they don't have to go out and refinance a loan at a higher amount. This is not for the inexperienced investor. As I mentioned before, most people will never do this. This is really something that requires knowledge, strong systems, good legal support, lots and lots of cash reserves, and really good systems and processes to make this work. Now, in my work as a financial planner for real estate investors, I've encountered a few folks. They do this for a living. This is what they do. This is how they do deals. And that's what they specialize in. And they do it very well. There are substantial risks to these transactions, and let's talk about them. So the first and most important risk is that many mortgages have what's called a due on sale clause. That means that the lender has the right to call the loan when ownership changes. So the law allows lenders to enforce this. So in practice, it can be enforced at any time. However, very often doesn't get enforced. So we see this due on sale clause come in. In another example, we also see it come in like when somebody transfers the title of their rental property into an LLC that is wholly owned by them, for example. Often the mortgage lender does not call the loan, although they certainly have the right to call the loan if there's a due on sale clause in the mortgage document. And so this is the biggest risk for a subject to investor. And what you often see that investor do is they buy the property subject to, they make the necessary repairs and renovations, and then they either go on to flip the property, in which the mortgage gets paid off at the next sale, or they refinance it when the property is worth more and they refinance it into a more conventional loan. So that is the number one way that a subject to investor is going to eventually try and dig out of that risk is by not keeping that loan for decades. Now, that doesn't always happen. If you have a subject to deal and you pass away, for example, that contract passes on to your heirs, right? So that can get pretty complicated. The second risk is the credit risk of the seller. Now, this is more of a risk to the seller than the buyer, obviously, because the loan stays on the seller's credit. That can affect the ability of the seller to go out and get another loan or credit card or student loan or something like that, because that counts against their debt to income score and it's going to show up on their credit report. So if the buyer pays late or, God forbid, defaults on the seller's loan, the seller's credit is damaged, the seller might have to take legal action against the buyer, and that can get messy and expensive and complicated. The subject to buyer that has a really strong system and workflow that they are sharing with the seller to help reassure them, okay, the mortgage is going to get paid, and here's how it's going to get auto paid. And they have a system for that is important. So the third risk I would say is, let's call it insurance risk or liability risk. So the insurance has to be properly structured in this deal. Typically, when the seller is selling to the buyer, the seller's mortgage lender has collected information about the seller's insurance, and that insurance policy is reviewed by the mortgage company regularly, right? But now we have a new buyer who has an insurable interest in the property, and so all of that has to be properly structured so that there is continued insurance on the property that covers the liability of all the parties involved. So the buyer has to assure with the insurance coverage that liability protection is aligned with ownership, not just with the seller's interest, right? Otherwise, if let's say the property was turned into rental and there was a fire and somebody was hurt, if the buyer wasn't named on the insurance, then they could really be on the hook for a lot of liability. The fourth risk, I would say, call it payment risk, right? The buyer has to make sure that he or she is making payments on the seller's loan on time. And if there are any issues like increases in property tax escrow or insurance, that sort of thing, that they are discussed and disclosed. Many investors who are buying deals subject to use a third party loan servicing company to make sure that they are getting those payments on time and everything is automated. The next area of risk is disclosure risk. Many times the seller of the property is in financial distress or in some kind of urgent situation. And so it's important the buyer must disclose to the seller everything that could, not just everything that could go right, but things that could go wrong, exactly how this works, because having it in an incomplete or confusing explanation could create legal exposure for both parties. That's why I think having a lawyer involved is definitely helpful. You really have to have clear written disclosures so that all parties know what they're signing and who's responsible for what. So you may be asking yourself, gosh, are these legal deals? Are subject to deals legal? And generally, yes, they are legal in the United States. There's no law that I'm aware of that specifically bans them. However, again, you've got to see a lawyer if you're thinking about doing one of these deals, either as the buyer or the seller, because whether the deal is legal depends on the proper disclosure, on the structure of the contract, on compliance with state real estate laws and lending laws, right? So somebody has got to review all these documents and the loan to make sure that it's allowed in the particular deal situation. There are a couple of states that have some rules around this or some heightened scrutiny, if you will, including Texas, which has strict interpretations around equitable interest and disclosure. Georgia, I think they have some stricter rules. My state of New Jersey, New York, Massachusetts, and California also have some fairly strict disclosure rules around this process. You do see investors doing these deals in different places. This is only for the experienced real estate investor that specializes in this type of transaction, but you can't do it sloppy. This requires to have really good systems and good, strong legal advice, as well as obviously identifying the right type of property. So, as a financial planner, here's some best practices to reduce risk. I think always use real estate attorneys who are familiar with this type of creative financing, written disclosures that are signed by the sellers, a third party loan servicer. I think that's super helpful. Also, the buyer needs to maintain very strong cash reserves and should always go into a transaction like this with a clear exit strategy, maybe 1 to 3 exit strategies that depend on different market conditions. Are they going to refinance? Are they going to renovate and sell? Are they going to renovate and rent and refinance? To think through these transactions in advance before entering into them so that there is the length of the subject to loan is limited, I think is the goal here. It's a real estate business strategy. Oh, we've been seeing more about this as interest rates have gone up, more content about it on the internet, for example, on social media. It's just not for everybody, right? It's for people who specialize in doing this type of deal. Now, if that's you and you want to learn how to do this, that's one thing. But for most people, it's not for them. Really, for experienced investors with high cash reserves that have strong systems and support teams. It's not, and under any circumstances, this is not for first time buyers. It's not for anybody without cash flow. It's not for somebody that has inadequate cash reserves or is living paycheck to paycheck. And it's not for anyone who isn't comfortable with legal complexity. In conclusion, the subject to financing strategy can be a powerful strategy for a certain slice of real estate investors, but it can also be dangerous depending on the execution. And it requires a lot of financial and legal education, strong ethics, professional guidance, legal guidance from attorneys and their CPA as well. So I hope that's answered some questions for you today about subject to loans. And we'll see you next time on the Real Life Planning Podcast.